Welcome back, financial investors. My name is Brent, and today I wanted to cover two topics in today's video. This was sparked by a comment I received over on the Facebook page. This investor had left a couple comments of portfolios, and they were actually doing fairly well. Their portfolios look really good from the links that they had shared. When I asked them, hey, which of these portfolios are you currently invested in? This individual said that he has not started invested in, he is waiting for the next recession. So what I want to do in today's video is cover number one, should you get started right now with the worries of the recession coming up in the future? And number two, how much equity, what should you be invested in my opinion, if you have less than 10,000, 20,000 or so on of equity in the market. I would say anywhere below $10,000 or less. Let's go ahead and cover that topic of where you should get started invested in your portfolio. So with that said, if you have not yet subscribed to the channel, I would highly appreciate it if you do hit that red subscribe button below. If you do enjoy this video, find it helpful with a thumbs up. And if you have any comments or questions, drop them into the comment section below. I am going through questions right now, looking for topics to make in upcoming videos. That way, if that question or comment is, a common question that other viewers, subscribers may have, then we can cover it here in a video, in an upcoming video here in the channel. So with that said, let's go ahead and get into the video. So number one, if you are brand new to the market, getting started, should you wait for the next recession or should you get involved now? Now that is all due to your personal constraints. So if you're looking at your own savings, your own debt, first, you'd have to obviously see how much you could get started with investing. So do you have a rainy day fund? Do you have debt out there to get started? Say this individual has no debt. They have $20,000 of savings and they want to get started right now. Well, let's go ahead and set $10,000 to the side, and that'll be our rainy day fund. Now, you have $10,000 left over. With $10,000 in today's market, should you get started investing? And the answer is absolutely yes. So what you could do in this case is, if you're brand new getting started, you split that $10,000 in half and you invest $5,000 right off the bat. So $5,000 goes into the market immediately, working for you. Now, yes, that market is going to be handed over into the market and it's going to go up, it's going to go down, but over the long term, so long as you're invested in sound companies or in quality exchange traded funds, that will go in an upwards trajectory. Now, as far as trying to time the market, let's tell a quick story of a friend of mine who I have been asking, when is he going to get started in the market? Well, this individual, I asked back in 2016, hey, you should get started investing. Check out this platform. Back at the past in 2015, 16, I believe I was using Motive Investing. And this individual, he said to me, look, we're 8 years past the past recession. We may go into another recession here in the future, and I'm not going to invest yet. I'm going to wait. 2016 passed. He said the same thing in 2017 and 2018, and now currently in 2019, he is still on the sidelines waiting to get started investing because he doesn't know when the next recession is going to happen. No one knows when the next recession is going to happen. So in my opinion, it is always good to get started right now, because the sooner that you get started, the sooner you know whether your positions are too high or too low. And if the market does seem to pull back a little bit, you can always add more equity. You are not going to be getting started with $1,000, with $5,000, even $10,000, and that's going to be it. If you are investing and getting started right now, set up a plan to continuously add equity into the market, either every week, every month, or every year. That way you're constantly adding equity into the market. And if the market does happen to go down during a period, well, guess what? You have brand new equity going into it in the future, which will lower your unit costs. It'll increase your yield on costs. You'll be able to buy additional shares at cheaper prices, and your dividends, if you have a stock or exchange traded fund that pays out a dividend, you'll be able to receive more dividend income. Those dividends that are getting paid out will buy back more shares at a cheaper discounted price, and over time that fund will move back into the positive direction or will continuously creep higher depending on the market. Right now we don't know if the market will go higher, if the market will go lower. There's a lot of signs out there, but the first thing you know right off the bat, how much time do you have really to get started and invest? Unless you plan on quitting investing at 60 and you're 30 right now, you don't just have 30 years until 60. It's until you basically die. So what's your age here? As far as age, I believe 85 is the current average for, where we end up croaking the bucket. So we'll say that I'm 34 years old and I'm going to be living till 85. That is about 50 years or so that I have to actually be invested in the market. Is my risk tolerance going to change in that time frame? Yes, somewhere in between those 50 years, my risk tolerance will adjust. But right now, as a young individual, I don't really have to worry about this next recession. Guess what? I'm still going to be working. I'm still going to be hustling. I'm still going to be adding equity into the market. So trying to time this market in these current conditions is not really worth it. All that we can do is get started right now. Let our portfolio, can buy back more shares right now, get paid dividends, and just throw more money at it. And over time, it'll all work itself out. So that is basically it. I know my buddy, he has said he's wanted to get started invested in the market for the past 3 or 4 years now. And he has missed an incredible amount of appreciation. But not only that, it's the share amount that you own. The faster and the younger that you are to get started, that's when you begin to appreciate or collect more shares. You get started in 2018. If I took the same equity that I have right now and went out there and tried to buy the stocks that I currently own, I would not have the same amount of shares. That is because during my time frame in the market in the last year and a half, these dividends that have been paid out from my account purchased back more shares with equity that I did not have to personally deposit into my M1 Finance Roth IRA. That is additional shares that I didn't have to work for. It just automatically purchased them for me, or I targeted specific stocks in order to add it into my portfolio. Market right now, absolutely yes. There is no reason to time the market because you really don't know if the market will trend for another year. Right now, we've been trending sideways for a year and a half. We're building up to something. Are we going to go higher because of a trade deal with yields getting cut? Or are we going to go lower? Maybe we don't have a quick fix here with the trade war and it escalates a little bit further. We may deteriorate, who knows? But you'd have years to get started and stay long in the market. Now, the next topic here is what you should get started investing in if you have less than $10,000. Now, here on the channel, I don't discuss it a whole lot because it's not probably fun and entertaining. I have an M1 Finance account that I use for my wife. It's the M1 Finance Roth IRA. That is the main account here that I showcase here on the channel. And it has about 30 to 34 different individual stocks. Now, if I was investing in ETFs here on the channel and looking at my portfolio on a week-by-week basis, when I was only investing in either 1 or 2 ETFs, it would probably get really boring. But I want to have fun with this channel. I'm trying to track my journey here financially in both the stock market and collecting dividend income, showcasing how to get started with a dividend portfolio, how to watch it grow and appreciate and continue to grow and pay out dividends. And I'm also doing my real estate business. But I like to kind of showcase the M1 Finance dividend account because it shows that everyone can get started. You can pick stocks and it'll appreciate, it'll depreciate, and it'll kind of move in line. Now, the M1 Finance account, it doesn't always track the market. Sometimes it excels and beats it. Other times it underperforms it. But the M1 Finance account as a whole makes up a very tiny fraction of my total portfolio. I believe the M1 Finance account makes up roughly 10 to 15% of the total equity that we have invested in the stock market. So as a brand new investor with less than $10,000, my first $10,000 was in an S&P fund. It was in something that tracked the market. Some of the most popular ones out there are the iShares S&P 500, I believe it was. It's ticker symbol SPY. This one tracks the S&P 500. It has a very low expense ratio. The other one that's very comparable to it is the Vanguard S&P 500 fund. This is one that I have myself inside of the M1 Finance taxable account. It is also tracking the S&P 500. I believe that one has an expense ratio of 0.03. Now, inside of my thrift savings plan, inside of my Roth 401k, inside of my other IRA account over on M1 Finance, I have ETFs and funds that track the market because these are not accounts that I actively watch and track. So if you have less than $10,000, get started investing in something that tracks the market your first $10,000, because say you have $10,000, split it in half, get started with $5,000. Now you know if the market will move higher, if it will move lower. If you invest and it does downtrend 1, 5, 10, 15%, set up a plan to continuously add equity into the market. You know, you have $5,000 sitting on the side, maybe add $200 every week until your portfolio begins to balance out. Or if it's diving down pretty hard, maybe add a little bit more capital in order to lower your unit cost, increase your yield on cost, and also depending on the exchange traded funds that you'll be picking, both the S&P 500, the SPY, the ticker symbol VOO, they also pay out a dividend right around 2%. The other one I would recommend, and I see a lot of investors buy in, is VTI. This is the total market, the Vanguard total market exchange traded fund. That's another very popular one that has a mixture of about, I believe it's 2,000 different individual stocks. The S&P has roughly 512. So there's a different balance there. But as a brand new investor, you shouldn't be worrying about trying to analyze a stock and figuring out whether it's overvalued or undervalued. You should just be focused on getting started. And by investing in an exchange traded fund, this will get you in the market. You won't have to worry whether we're going into a recession, whether we're going to go into a pullback, because you have time on your hands. Plus, if it does pull back and you're invested in an exchange traded fund, you can just add more money into it. It'll lower your unit costs. And over time, it'll increase with the market as it rebounds. It may take a few months, it could take a year, it could take multiple years. As we've seen here in the last year and a half, the market hasn't done much. But if you hadn't been invested in a company or stock that pays, or exchange traded fund that pays out a dividend, you would have collected dividends during that time frame. My M1 Finance account, going forward from today's date, will make $606 in just dividend income. This is from an account that I just started back in 2018. If I did not invest any more capital into this specific fund, it would continuously pay out over $600 of dividends every year, or $50 on average per year. But I am not stopping right now. I have, as I said, roughly 50 more years of being invested in the market. And over 50 years, that is a lot of dividends that are going to get paid out to me, that I'm going to be able to buy back. And of course, I'm going to be adding more and more equity into this portfolio. And by the time here in just a few years here, we're going to be tracking it in this channel. We're going to see this portfolio surpass 1,000, surpass 2,000, and continue growing into the thousands of dividend income getting paid. So as a brand new investor, just really quick recap, do not wait for the next recession to get started. Getting started right now, even if you have just $100, $5,000, $10,000, and you get started, and we do go through a crash, you are not stopping and pulling out right now. Depending on your financial stability, make sure that you're going to be financially stable. You're not going to need that money. Any capital that you invest, make sure that you're not going to need it personally for yourself. If you take it out for some other side investment, make sure that your return will at least keep up with the market or exceed it. The average for the S&P 500 is 7 to 10%. So make sure that if you do withdraw your capital out of the market for any needs, make sure that you're reinvested into something else that can either drive you at a 7% or higher average, and that would be fine. Otherwise, keep it invested in the market. If you do need to pick up other side jobs in order to fund any sort of issues that you're partaking, do that, but don't try and remove capital from your portfolio over the long term. Otherwise, you'll kind of hurt your results. So that is pretty much all I wanted to cover in today's video, hitting both of those topics on whether you should wait for the next recession to get started or get started now. Obviously, you want to get started as early as you can because that'll give you the best benefit over the long term. And number two, if you have less than $10,000 to get started invested in the market, get started with the S&P 500, ticker symbol SPY, or ticker symbol VOO, or the Total Market Fund, which is ticker symbol VTI. I'm not sure if I said that earlier in the video, so I wanted to go ahead and say those three ETFs are excellent to get started in the market. And if they do go red, just add more equity in, lower your unit costs, increase your yield on costs, and increase your dividends going forward. So if you have anything you would like to add into the comments of this video, go ahead and type it in right now. Drop me a comment saying either you have any questions or do you agree with getting started right now in the market. Type yes, I agree with getting started regardless of the next recession. And what is your plan? What would you do if I handed you right now $10,000 to invest in the market? What would you do with it? How would you split it up? Let me know in the comment section below, and that is it. Thank you all for tuning in today's video. If you guys have not yet subscribed to the channel, I would highly appreciate it if you do subscribe to the channel. If you do like this video, find it helpful, hit the thumbs up. And if you have any comments or questions, again, drop them into the comment section below. I do read and apply to all your comments, and thank you all for tuning in. I will see you next time. Have a great day. Bye.